Hello, chart watchers, and welcome to this Friday, December 15th, Market Watchers Live Show with Aaron Swinlin and Tom Bowley. I'm your host, Tom Bowley. Today's show is being recorded, so you should be able to play back any or all of Market Watchers Live at your leisure. If you're unable to attend the show live, you can now go to www.stockcharts.com/webinars, follow the link to Market Watchers Live, and play back the show. Each show will be archived on our site until the next show begins, so you'll have roughly 24 hours to review. If you'd like to review an older show, you can now find those at our YouTube channel or on Facebook. During today's show, please feel free to submit ticker symbol requests, questions, and comments using the chat window next to the video player. Later in today's show, we'll select stock symbols from your requests, and I'll use those in the 10 in 10 segment at 12:50 Eastern Standard Time, where I'll attempt to annotate 10 stocks in 10 minutes. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. If you'd like to be part of the show, you can now reach us via our chat room or Twitter. Our Twitter handle is at Market Watchers Live. That's at MKT Watchers Live. As you leave today's show, we'd love to get your feedback. In the lower right portion of your screen, you'll see a How'd We Do section, and then there's a link below to a very brief survey. Let us know what you think of Market Watchers Live, and feel free to provide us suggestions for how we can improve the show. For those of you joining us for the first time today, welcome to the show. We are certainly glad to have you on this Friday. And for our regulars, welcome back. Just a couple quick announcements before we get going today. First, in about maybe 10, 15 minutes, I'll be going through a segment on price support and resistance. A lot involved in that, more than you might think. So looking forward to sharing that with you. This weekend, we have another Chart Watchers newsletter. That will be out some point tomorrow. And, of course, it is the second and final one of December, so it'll be the last one of 2017. Should be really interesting to see what everyone makes of the recent market action. Greg Schnell will be with us next Wednesday, December 20th. So mark your calendar for that. It's always fun to have Greg on the show. And with that, I will bring in my co-host, Aaron. How are you doing this morning, Aaron?
It's Friday, so I'm doing quite well. Thank you.
Always a good thing, right?
Fridays are almost always good. So busy day. Lots of shopping and finishing up to get ready for the holidays for sure.
There you go. I tell you what, we're running out of shopping days. Although my shopping season hasn't started yet. I still have probably about another week or so before I have to get into shopping mode.
Well, I understand that most don't take it personally, males out there, but typically it's around Christmas Eve. that's the shopping day for most of the guys I know. So
that's most of the traffic that I'm worried about is Christmas Eve, but
yeah,
maybe I'll get out a little earlier. But anyway, I know we got a lot going on. We got a pretty busy schedule, so I'm going to let you take it away with the agenda and the first market update.
Absolutely. So yes, market updates on the hour. Then we have some technical headlines to throw your way. Tom will go over some reports, price and resistance and support. As Tom said, he's going to be doing a workshop on this shortly. Don't want to miss it. 10 and 10 to 1 will follow that. And the first one we're going to look at is Costco wholesale. So if you want to go take some notes on Costco, you can do that and then compare them to what Tom says about them. I'll be giving you a sentiment update to finish off the Friday, let you know what everybody is feeling out there as far as bull or bear, also where the money's going when we look at the RIDEX ratio. And then we'll finish up with the mailbag and wrap up. So if you have questions during the show, feel free to add them to that live chat box. Or if you have questions that we can answer in future shows, go ahead and email those to us at marketwatchers or marketwatchers@stockcharts.com. And of course, Twitter, we do follow that as well. And with that, I'm going to go ahead and move us into our first market update. All right, let's take a quick look at what the markets are actually doing right now, and then I'll look at some headlines for you. At this point, we can see the Dow, pretty much all the major markets are moving higher. Look at that move on the NASDAQ, pretty much straight up with barely a pause or pullback. Technology seems to be coming back to life here. as we continue into December. Russell 2000 and small caps are rallying nicely, of course, because I just wrote an article about that they look bearish on the indicators. So, but Tom, you did call that one. You're telling us that the second half of December does help the small caps, but we'll have to see how that pans out. Treasury yields are up, but they are pulling back just a little bit on the day. It's 23.69 currently. UUP is on a nice trajectory higher. Appears we're taking a little bit of a pause after a nice strong rally. UUP reading 24.41. Commodities started up and then it pulled all the way back, and now we've got a candle below yesterday's close. So it's not looking too good right now on commodities. USO, again, had its really nice rally, really pulled back, got into negative territory, took off again, but now we're right back on yesterday's close. We could see that gold also had a really great open with a gap and has fallen since then to test yesterday's close, but it does appear to be making a bounce. The VIX is going lower and lower, so we can see that people are starting to get a little bit more bullish, complacent about the market. Advances leading declines. So let's go look at our member homepage here for our predefined alerts to let us know what the headlines are currently, and there are quite a few. Obviously, we're seeing new intraday all-time highs for many of the indexes, the Dow and NASDAQ in particular here, S&P 500 earlier this morning. And then we can see that the Russell 2000 did cross above 1525. So interesting to see that. We can also see that consumer staples had a 5,200-day EMA crossover. And as far as decision point analysis is concerned, consumer staples has now moved into a bull market configuration. So consumer staples starting to do very well. The bullish percent index, we can see cross below 70 on the NYSE. So not as good a day going on there. And we can see the technology sector, not a surprise to see the BPI cross above 70. And, after a nice rally like we just saw. And it just updated, but we're still looking at the most latest as the Dow setting a new all-time high. And with that, I'm going to pass it back to you, Tom, for some technical news. And I know that you've got a lot to present, so we need to give you all the time we can.
All right. First, let's jump into some of the economic news that came out this morning. We did have the December Empire State Manufacturing Survey come out, and it was exactly as expected, 18.0. The November industrial production, that came out at 9 o'clock this morning, so about a half hour before the market opened. That came in at a rise of 0.2%. The market was expecting just a little bit more, a rise of 0.3%. And then November capacity utilization also came in just slightly below expectations, 77.1%. The market was looking at 77.2%. And on the screen here, I've got the 10-year Treasury yield. And really what I was expecting originally is off of this uptrend from early September through the end of October. Thought maybe we were going through this little triangle, higher lows and lower highs, and we were squeezing. We broke out. And I guess technically we could have gone back and tested this downtrend line when we got down to about the 232 area. And it still is holding this lower uptrend line. So I'm going to still be very bullish with the 10-year Treasury yield, expecting that we're going to go higher. And that should set up things pretty well for financials and industrials, both of which seem to be doing very well with the yield in an uptrend off of that September low. So I thought what I would go into today, we haven't looked at this in a while. I'm going to go through the various sectors. And to me, the market still remains very bullish. And I like to look at these sectors and how they're performing relative to the S&P 500 when we're getting new all-time highs or new highs. In this case, the new highs happen to be all-time highs. But with technology here, you can see the top chart that you're going to see on here is the absolute performance of technology stocks, the XLK, and then the bottom part will be the relative performance of the XLK or technology versus the S&P 500, so versus the benchmark. And what we can see is that technology not only continues to move higher, we had a little bit of a scare, went back, almost hit that rising 20-week moving average, And you can see briefly we had a little bit of a pullback on a relative basis, but it looks like technology is gaining strength again. And as Aaron pointed out in the update, we've got the NASDAQ. I think 69.12 is the highest close that we've seen on the NASDAQ. That's an all-time high close. And I think it was 69.20 when Aaron was pointing it out. So we do have the what appears to be maybe another breakout to an all-time high on the NASDAQ to follow what we've been seeing on the Dow Jones and the S&P 500. But I find this to be very comforting. This is one of the more aggressive areas of the market, technology, and we continue to look very good on both the absolute, and we're starting to pick back up again on the relative strength versus the S&P. So I think that's a really bullish indication. Financials, very similar. We continue to remain in an uptrend. We recently broke out above about a 1-year relative high on the XLF relative to the S&P 500. And after pulling back, well, on a relative basis, we pulled back. We actually just went sideways on the XLF. But because the S&P 500 has been making new highs, it actually shows as a relative pullback here. But financials are leading the market today. So all looks good to me here. This is the second of the 4 aggressive sectors that I like to follow. The third is the industrial space. And again, you can see price action continuing to rise. And even the relative strength, which you might look at and say, well, it's sideways. That just means it's going along for the ride. So it's not like it's underperforming. It's just been throughout 2017, maybe a slight outperformance of the S&P 500. But I think both the absolute chart and the relative chart here with the industrials looks good. And the one that was starting to show some relative weakness that you can see throughout the summer months, this is actually picked back up. This is the consumer discretionary ETF, the XLY. And I found this triple top breakout that we saw about 4 or 5 weeks ago to be very bullish. And we've risen, I don't know, maybe another 7 or 8%. No, maybe not quite that much, maybe 6% since we broke out of that triple top around $91, $92. And you can see the relative strength after going down and testing this breakout level from literally 2.5 years ago. We hit that level and we've been bouncing. And much of this is a result of the strengthening retail space. But there's a lot of areas in consumer discretionary doing well. And it was just nice to get that bump from retail as well. But that's why we're seeing this relative strength over the past 5 to 6 weeks. And what would be super bullish for the market is for this relative strength to continue and to take out this multi-year high. This is a relative resistance area. So those are some things to keep in mind. But right now, the 4 aggressive areas of the market, to me, look excellent. When we start talking about the more defensive groups, what we want to see is wide participation. We want to see the groups continuing to move higher, as we're seeing with healthcare. But it's okay if these groups, these more defensive groups, underperform. So here on a relative basis, we've seen a recent breakdown in healthcare, but not on an absolute basis. We continue to move higher. So healthcare is participating. It's just not moving up as fast as the S&P 500. And that's honestly, that's what we want to see. Same goes with consumer staples. Now, we did see a little bit of relative strength with this huge move up recently, but the 2-year pattern here is clearly down. Consumer staples relative to the S&P continues to struggle, and I think that's a good sign for the market. We've got clear breakouts, so it's participating, but it's in a downtrend relative to the benchmark, which I like. And utilities, same thing. We're in a nice uptrend, actually coming back down. Looks like maybe another test of the rising 20-week moving average. But on a relative basis, you can see utilities are a little disappointing. But again, this is a defensive group. This is what you want to see. You want to see money rotating in a bull market towards the more aggressive areas. So those are all pretty interesting charts, and I think good charts to keep an eye on. A couple of stocks, well, one stock in the news, CSX. This is a company that their CEO, Harris, what's his name? Harrison, I think. I can't remember if that's his first name or his last name. But anyway, apparently his health is not doing well. He's got some complications from a recent illness that was disclosed today, and you can see CSX taking a big hit as a result on extremely heavy volume. So don't know exactly what this says. I didn't hear anything more about the news other than that there are some complications. I think his name's Hunter Harrison, the CEO of CSX. But anyway, there was a pretty good price support around $54.50, $55 from all these recent tops, and we're going to be talking about that price support and resistance in just a minute. But we did gap back down below that level. So at least in the short term, CSX under some technical selling pressure. Three more stocks I wanted to go over. These are companies that reported earnings last night. Really the only three big companies that were reporting earnings all week. Oracle came out. They beat their bottom line estimate, but the market wasn't overly impressed. But I do like what's going on since the open. The fact that we were down, breaking down, and so far coming back up and holding on to price support. So right here was the recent lows in terms of price. You can see multiple tests. We went below that intraday and below the 200-day and on very heavy volume. So to me, there wouldn't be a whole lot of reason down in this 47 area to be buying the stock, yet it has reversed. That could be a sign that we've got market makers building inventory, and that could be a very bullish sign, but we do need to see where Oracle finishes today. But based on the technicals, I do like this recovery so far. The other two, Adobe Systems, ADBE. Now, Adobe Systems beat top and bottom line estimates. Did gap up earlier, but it's in a trading range. I don't see anything bearish at all about this chart. And in fact, when we moved all the way back, you can see that volume picking up, but we hit the top of gap support and we bounced off of it. So I think this is just simply in a trading range between about 165 and 185. We gapped up, pulled back, but I think eventually Adobe looks bullish to me, and I would eventually look for a breakout to the upside out of this pattern. And the final one is Costco. It's one of my favorite stocks, not so much in terms of price action, although price action looks great, but that's actually one of the stores I like to shop at. Costco and Starbucks, two big favorites of mine. But anyhow, great reaction here on Costco to its earnings, where it beat top and bottom line. And I think we talked about this one recently, just saying that based on the way it was trading, it reeked of bullish earnings report coming out. And we got that, and apparently it was good enough to at least send it up on an intraday basis. We'll see whether or not we hold. If we finish with a candle like that, I mean, you can see the volume's pretty heavy today. If we finish without being able to go higher after the gap up, then I would probably look for a pullback at some point. And I think maybe that rising 20-day moving average, as it comes up and coincides with some price support in the 185 area, I think that would be an interesting entry if Costco were to pull back. So with that, I am now going to move into my support and resistance, price support and resistance segment. So let's move over and take a look at this. All right, a couple things I just want to, before we really dig into these charts, this support and resistance segment, I'm going to go over a few things. Number one, just talk basics about, what is price support and resistance. I think it's important that you realize that price support and resistance can vary by time frame. So day traders and long-term buy and holders are going to be looking at completely different support and resistance levels. We'll talk about that. I'm going to give you a lot of examples of price support, resistance, and how I use it. I'm going to go through a couple of examples of false breakouts at price resistance. Many times these signal tops, and I think it's really important to be able to recognize those. Give you a quick analogy on how I view price support and resistance, but we'll go through that. And then finally, we'll wrap up with combining price support and resistance with other technical signals. So looking at this first chart, this is PNC. Of course, this is a bank. And as you can see, broken price resistance. This is like a technical analysis 101. Broken price resistance becomes price support. Now, this gets back to the question, what is price support and resistance? Well, in its basic sense, price support is a level where you expect buyers to show up because they have shown up there in the past, or because you've cleared a prior price resistance, and that becomes support. But anytime you start talking about price support or price resistance, what you're really talking about, in essence, is a battle between demand and supply. So the supply are the sellers, and then demand are your buyers. And so when you get to a point and you reverse at certain areas on a chart, For instance, back here in March, you can see on PNC, we had the big move up. Well, right here is where sellers began to get the upper hand. And so the buyers, all that demand, kind of gave way to the sellers, and then the downtrend started. And when you get down to an area where the selling pressure weakens and the buying pressure starts to pick up, then you'll see a reversal. And so that would be considered price support. So that's all it is, just in its basic form, is it's an area where you start to get reversals and where demand weakens in terms of resistance, demand weakens and supply picks up. And then down at the bottom, you can see supply weakens and demand picks up. So the buyers are able to wrestle control away from the bears and the sellers. And that's essentially what you see on charts. You get price action up, back down, up, back down. But there are times when it becomes much more important. And when you get heavy volume breakouts above prior areas of resistance, because what you expect in technical analysis and what technical analysis tells us is that based on history and based on things that have happened in the past, we can begin to predict what is going to happen as we hit certain areas. So for instance, you can see a high here in August, and the volume was really strong in September. We came up, we went right through that resistance. So we didn't pause. We went right on through it. And that prior price resistance then becomes support. And you will see here over the next, I don't know, maybe 2 months or so, these 3 green arrows. Actually, I probably could have drawn another one in right here in October. But every time we went back to what was prior resistance, that became support. And so once we're able to get through a prior high that we were previously unable to do so, it gives the buyers the advantage. So you get through, and now all of a sudden, the sellers that you expected to be at the prior high are gone. When you get a breakout like this, normally, we refer to blue skies ahead, or maybe you go back into a longer term chart and try to find where the prior price high was. But in this case, we moved up, and each time we pulled back, probably at least 4 or 5 times along here, we came back to this 132 area and we held and then turned back up. And as you can see here, volume picks up end of November, and we take out this prior high, which was established in October. So once you set a high, can't get through it, and you start turning back down, you look to that prior area of support for the buyers to come back in, for the demand to pick back up. So that's why in my trading, I like to use these support levels as key entry, because if it doesn't hold, then I think we've got some issues and I can keep my stops relatively tight. So now with PNC on this breakout, this recent breakout with heavy volume, now that prior resistance becomes support. And there's your green arrow to mark. Now we haven't gone back down there, but if we do get back down to about 139, 140, I'm going to be looking for buyers to show up. Does it mean that they're absolutely going to show up? No. Nothing in the market is a guarantee. Technical analysis does not try to provide us guarantees. It helps us manage risk. Big difference. All right, so let's keep moving here. So this is a daily chart. But if I pull up a 10-minute chart, you're going to see a completely different area of price support. I mean, I was looking at this chart on PNC, and I see, back on would have been Monday of this week, PNC got up to about 144.80, pulled back, got up right to that level again, left a couple of tails, meaning that it moved above temporarily, but came right back down below 144.80, and then broke out above 144.80. Then notice we come back down, and where do we test? On the way down, 144.80. We bounce, come back down, test 144.80, bounce one more time, then back down we go below 144.80, and now it becomes resistance. It was support. Actually, it was resistance. We went above it. It becomes support. We go below it. Now it's resistance again. We come back up to 144.80. We fail. Move all the way back down. And then finally, this was actually done earlier this morning, but now you can see we're actually trying to negotiate this 144.80. And recently here over the last hour, we've gone down and tested it a few different times. Now, from a day trading standpoint, these levels are very important. I mean, 144.80 from this chart looks to me like the major area where we see the most directional changes on the chart. So this seems to be where, on an intraday basis, the buyers and the sellers, really having a battle. And so you look at this chart and you say, okay, 144.80 looks like a pretty big level as a day trader. Now I'm going to take you to a weekly chart, and I want you to tell me what 144.80 means on this chart. I mean, it means absolutely nothing. Here you've got a stock that has been trending higher for a year and a half. And I mean, are you going to sell if 144.80 is lost? I don't think so. But, clearly it makes no difference to someone who's got a longer term time frame. So that's really the key takeaway here, is that your price support resistance on a short term daily or intraday chart is not going to be the same support on a more intermediate term chart like the daily chart, or a long term chart on the weekly chart. Here, if I was looking at this, this is where you see multiple tests recently come down to about the 115 level. This was earlier in 2017, but on a weekly basis, it held. We tested it over a period about, I don't know, maybe 8 weeks, 10 weeks, and it continued to hold. We went back up. We tested the prior high, maybe got just up a little bit above it, pulled back, and then we broke out above that prior high at 130, and notice where we pulled back to, 130. But notice that on these longer term weekly charts, your range between key price support and key resistance are much wider. So it enables you as a longer term trader to ignore those daily moves or even those intraday moves like I was showing you at 144.80. They really don't make any difference on a long term chart. So the key here, again, key takeaway is just simply that you have to understand your own trading style. If you're a weekly, or if you're looking at weekly charts and you're a long-term trader, the intraday charts really don't mean anything to you. Looking at that and all the wild swings back and forth are really just going to drive you crazy. And likewise, if you're a day trader, you need to pay attention to that 144.80. But to go back here as a day trader and say, well, my support's at 115, that makes no sense whatsoever. I mean, you're certainly not going to be holding the stock for $30. So again, you got to understand who you are, and the risks that you're willing to take and the time frames that you're willing to trade under. Some can look at the market all day long. Others don't have that kind of time and don't want to take that kind of time. So you do need to kind of figure out which chart makes the most sense for you. Now, I had marked a bunch of other areas. I mean, you can see here on this chart, look at all these green arrows marking support at these two levels. So, and this is over 2.5 years. The strength of any support or resistance line is really determined by how many times you have successfully defended that area. So if you go up and you come back down and you test it one time, support, and then you bounce back up, well, when you come back down, yeah, it might hold. That's where it held last time, but you've only tested it one time. So if you were to break down, would that be the end of the world? Probably not. Maybe you're going to see a little bit more selling, but maybe we go to the 50-week moving average and bounce off of that. But when you're seeing multiple long-term support like this, and I just kind of called this a support zone. I mean, we're way above that now. I certainly wouldn't be holding on unless we, went below $75. I mean, I'd be out a long time before that. But back then, if we were to rewind to maybe about 15 months and we looked at where we were, I think it would be pretty obvious that this is a very significant area of support going across here, and something that you should pay attention to. Another way to illustrate this to some degree is to use an overlay, volume by price. And what this does is it tells you the volume in different closing areas on the chart. So for instance, over the last, 3-4 years, maybe actually 5 years on PNC, anytime that we had a weekly close, say in the 83 to 88 area, anytime that adds to this volume bar coming across here. And so the other level here below, maybe from 75 to 82 or whatever, you can see all of these closes and some closes over here. All of the volume for these closes that fall in this area or this range gets added in coming across here. So I think it's pretty clear. Not only do you visually see the line coming across here, but if you use the volume by price, sometimes that too will provide you the biggest areas of support and resistance, because this is where this particular stock has closed in on a weekly basis going back the last 5 years. So it's not just me saying, oh, this looks like a really critical area. It also is being supported by the number of times that we've seen a weekly close fall into this trading range and all of that volume being added up. So this is another way to take a look at price support and resistance. I think this is a great tool. Okay, so let's keep moving here, and let's get into some examples, some other examples, price support and resistance. This is Devon Energy DVN, and you can see the stair stepping here that's been taking place since this downtrend ended. You can see coming across here, there was a little bit of a reaction high here, almost back up to this 33.75 area here. And then finally, look at all the tails, all the tests trying to get through 33.75 here, and we fail. So again, sellers are getting used to finding other sellers when we get up to the 33.75 area. We keep failing there. It just simply means that supply is outstripping demand. When you get up there, you got demand in your favor, you get all the way up there, and then all of a sudden can't get through. More sellers show up, and then you roll back down. But notice here, we went up, went sideways after a failed breakout attempt, and then finally made the breakout. Pretty decent volume, I would say, on this move to the upside. Looks like maybe over a week, maybe 6-7 trading days. Pretty strong volume. And then on the pullback, where do we pull back to? Price support. Old price resistance becomes price support. So broken price resistance becomes price support. And so we went right down there, bounced off of it, right back up. Look at the volume this time. Big volume on the move back through. And now prior resistance at 37. Check out, this pullback here where we've gotten back down around that 37 area and then tried to turn higher. So for me, it looks like 37 to 41 is a trading range on DVN. This is your current level of price support. This is your current level of price resistance. If we get through 41, next key area looks like to me around 43 or maybe just beneath 43. We had a prior low that was support. We bounced. And then when we came back through here, look at the volume pick up. And on the move back up, we failed right where we had broken down. So broken support, in this case, becomes resistance. And then we make our way back down. So it's stair stepping. You can kind of see the stair stepping. To the downside, you stair step lower, and price support tends to fail. And then as you start stair stepping higher, price resistance tends to fail. And you continue to establish higher highs, or excuse me, higher lows and higher highs. Next chart. This is an interesting one because this is a false breakout. I want to show you kind of what a false breakout looks like and why I get really nervous when I see these false breakouts. I think it's pretty clear off this uptrend that we established over this week or so that price resistance came in at about 895 or so on this chart. This is the Dow Jones U.S. Gambling Index. So back in June, you can see us get up to 895, struggle, can't get through. We pull back, get back up over 8. Actually, I think that's 890. I said 895, but I think that's 890. Anyway, we get back up to about 885 or so, turn back down. And then here, look at this, where I put this red arrow. See that move where that tail is above price? It looks like it's breaking out intraday, but then it comes back down and it closes below that level. And then look what happens over the next 8 weeks. Now, as a trader, short-term trader, if you're in gambling stocks and you see a false breakout like that, and you know that short-term that can create some problems, it's going to be a very difficult period potentially holding gambling stocks. So you want to really pay attention to these prior resistance levels and the failures to break out. That particular day, that was September 7th. I want to show you in the Don't Ignore This Chart blog. I wrote about this on September 7th and just indicated the gambling index printed a reversing shooting star candle. And you can see at the time what it looked like. And anytime I see that on a big move to the upside and a false breakout, it just makes me aware that we could be in for some trouble. Now, in this article, I just indicated maybe we would see a pullback for a couple of weeks. It turned out to be a lot more than that. But also I suggested if you were into any gambling stocks, you might think about taking some profits based on just that failure at price resistance. Because prices, to me, there's nothing more important than price action. Price support levels, price resistance levels, to me, trump everything else. And I've seen big moves down on heavy volume and then price support hold. And it looks like, my gosh, with all the selling pressure, there's no way price support's going to hold. And then it holds and the uptrend resumes. So it's somewhat difficult to hold through a heavy volume move to the downside, but I still think it's worthwhile to pay attention to where your price support resides. All right, now on this particular move here on the gambling index, I want to show you the next chart, which is a weekly chart of the gambling index. This happened back in September right here. Now notice we made this move up, we pulled back, we were holding mostly the rising 20-week moving average. Here was the false breakout, and if you notice at the time, there were a couple of things. Number one, you can see that the MACD, weekly MACD, had turned down, suggesting that maybe there was a little bit of price momentum issue. And down below, when it did make the breakout, it actually did so on declining volume. I mean, it's actually one of the lower volume weeks of the year. So you're getting this, it looks like from a price perspective, you're getting a breakout, but momentum is struggling in two fronts: price momentum with the MACD, and then the volume is telling you there's just not a whole lot of movement behind this move to the upside. So it really is a combination of, and I always talk about price volume combo as being my number one indicator. So it's about price. I mean, I want to make sure that, I'm taking out clear price resistance, but it's also the volume, that momentum, that swoosh. You're looking for that big wave to come in of buying that easily confirms that breakout to the upside. We didn't get that here. So as we pulled back, I want you to take a look. This is another technical tool, but it's a simple trend line. If you connect the important lows since bottoming back at the beginning of 2016, notice that this pullback that we had right before we ended up coming back up to make the breakout, we hit trend line support. So there's more to this than just seeing a failure and, moving on to something else. I mean, if you're trading stocks in that area, you do need to take notice. And you also might want to pull back and look at a longer term chart, which I think is always a good idea to see the big picture. Here's another example of a false breakout. Take a look at BUFF, Blue Buffalo Pet Products. You can see the move up, nice volume. We top, bearish engulfing candle, established that top, pulled back, and then when we went back up, look at the false breakout. See that tail? Easily taking out that prior high, and in this case, volume was starting to pick up a little. Well, actually, no, this was a pretty low volume day. So price action, if you were just following price action intraday and you see this breakout, you might have bought. But the astute trader, I think, looking for volume confirmation would have been a little bit concerned. And by the end of the day, if you weren't concerned on the lack of volume, you should have been concerned by the failure on the breakout. But these false breakouts, these reversing type candles, can be extremely powerful for a short-term trader. Now, again, if we looked at Blue Buffalo weekly chart, all of this might just be, kind of in the mix. You may not even notice any of this. And that would be okay as somebody who's not following the market on a regular basis. But if you are following it in the short term, I think these types of signals are absolutely just, very important. Let me just say that. But anyway, let's keep moving because there are some other charts I want to get to. On Comerica, CMA. Now, one of the analogies I always like to use with price support and resistance is that during an uptrend, it really is like an elevator. And you can see that here. We're just kind of going sideways for a while. And then all of a sudden on this move up, we take out these prior highs, which was resistance. Now it becomes our floor. So think of resistance and support as ceiling and floor. So we break through, and now this is our floor. So we're standing on the floor, and we make our move up, put in the new high, and at the new high, that becomes the ceiling. We roll back over, we come back down, had a little bit of a head fake to the downside, but basically held on to gap support and turned back around. So we bounce off the floor, and we go back up to resistance or the ceiling. Kind of move sideways for a couple days, hit that rising 20-day moving average, and look at the volume come in, break out. That's why I like to see that confirming breakout, because that tells me now this prior ceiling should become a floor. And in this case, we move up, put in that black candle, sets the top up at about maybe 86 and change. And even before we did that, notice we came back down though and tested the top of gap support. Now I have a few lines in here, and this is where I want to get into a couple of more charts where we're combining price support and price resistance with other types of tools that you can use, other indicators when you're trading stocks. So I've got on some pretty good volume here, big gap up. So I've got gap support at 81, top of gap support's 81, bottom of gap support's 80.5, and price support's at 80. So I would look at this and say my gap or my support area is maybe between 80 and 81 based on price support, this floor going in, and then also I've got gap support. In this case, I came down, tested top of gap support, and then rose. And currently, I think we're in a trading range on CMA. We've got 80, I would say, is the floor, and our ceiling right now is up at about 86 and change, maybe 86 and a quarter, 86 and a half, waiting for the next possible breakout. Now, if you get this stock where you see an intraday move above this red line, you come back down and close below it, I think you got to be careful because that could signal another move back down to test this support area. We're in a nice uptrend, and even if we were to move back down to 80, you can see we would still have this trend line in play. So when I look at this chart, as I get up into the 85, 86 range, from a short-term perspective, I think the risks are growing to hold that position. If I was trading it, probably would take profits. Now, if I look down here and I saw a nice candle and maybe the volume was already 1.5 million shares, then I might say, well, we still have a half of a trading day to go. It looks like heavy volume. This could support a breakout. That I might stick around for, or maybe I'd sell half my position and see if I could get that breakout. Just a couple more charts. ISRG, Intuitive Surgical. Now I have a bunch of lines on here, kind of showing, again, those floors. So you had a double top here. You break out. You go back and you test it. And then you break out. You go back. You don't quite get all the way back down here to test it. Then you break out, come back and test it. And then you break out. And now you come back and you test the support level. Now, ISRG may just continue running from here, but I do think this one is showing some issues technically. So I'd probably have to see this get back up above the moving averages before I would consider this being a viable trade on the long side. Because number one, you can see throughout 2017, we had a really established, very nice trend line, and it broke on big volume. Not only did it break on big volume, but then it came back up and tested the falling 20-day moving average and failed. Normally, when you're in a nice uptrending stock, you come down, you test that 20-day, and you bounce. You see that throughout most of this uptrend. But in this case, we went below it and then failed from underneath. So this is starting to actually show more bearish tendencies. Now, I'm not saying that this stock is done. It could just be a case that this uptrend had gone too far too fast. Maybe we need to consolidate. Maybe ultimately we'll have a cup that'll form. There could be a lot of different bullish conclusions to this chart. But in the near term, I would be very careful with it because I don't know where it's going to the downside, and I don't like the fact that it is trading with a lot more bearish tendencies at this point. That heavy volume on the selling, the failure at the 20, looks like the 20 is about to cross over the 50, and that would be the first time. I can't tell maybe if it did that back in beginning of August or not, but throughout the 2017, you can see that 20-day has been rising, and it's been above the 50-day. Also, you can see that the MACD, since back in January, has been above the zero line. And now look at it, pointing down. So there's a combination of things. So now I'm looking at these support levels. Do I want to buy at support? Well, that it becomes a little tougher to do that. I know one thing, if I bought at support and it didn't hold, I'd be out. Because I don't like this, the MACD pointing down. I don't like the failure at that 20-day moving average. I don't like the volume that's been accompanying the selling. And it has made a huge move, and it's been overbought. You can see throughout the month of November, RSI was extremely overbought. The other thing, too, is during an uptrend, you might see RSI dips into the 40s, but normally you don't see it go below 30. Occasionally you do. But here we've actually made a couple of different moves now down into the RSI 30s, which makes me a little nervous as well. That's just telling you the selling is a little deeper than normal for an uptrending stock. And the final chart that I have here is F5 Networks. I really like this stock, and I'll show you some things here. First of all, I think it's pretty clear that we were trending lower for quite some time. But this sideways action here has actually been resolved back to the upside. And if you notice these heavy volume days, all three of these big volume days had hollow candles, meaning that you closed above the open. So a lot of negativity involved with these because we got these gap downs. But after selling off intraday, we did manage to close above the open. So it just tells you that there are buyers out there for the stock as it continues this action. And then you can see volume here moving back up. Look at that tail. Two days in a row, we had what looked like major breakout above 124, and we failed. And sure enough, came back down to around 120, maybe 119 and change, hit the 20-day moving average, and then turned back up, failed at 124 one more time. And then right here, notice the volume picking up. Those are three white soldiers. That is a three stick bullish pattern, candlestick pattern. It's very bullish. And I think right now we're just simply consolidating. I would expect, and I've marked it with a 20-day test, but I would expect that 20-day moving average to provide us some really good support if we were to pull back to that level. Now, maybe at some point what happens is we go up, get a new high. Maybe it's a negative divergence. Then we start looking for a 50-day test. And notice the 50-day is slowly rising up just underneath price support. So maybe this, what I would expect is a bounce off the 20, another push to the upside. Maybe somewhere down the road, we'll get back and test that 124 area, in which case that would be a great area to enter just because of the price support that we now see. So that is basically it. So again, just to kind of recap some of the things we talked about, what is price support and resistance? It's just simply when you reach a point where the buyers lose control in an uptrend or where the sellers lose control in a downtrend. So you run into a battle, and that is where the price tends to reverse. And where that reverses, that establishes either price support on a reversal back to the upside or price resistance when you reverse off of a top and start moving back lower again. Second thing to take away from this is you need to make sure that you have the right time frame that you're looking at. I'm more of a swing trader. So for me to go to a 5-day, 10-minute chart and find a support level, I'm typically not going to buy at a support level or sell at a resistance level on a 10-minute chart. Instead, I'm going to be looking more from a daily chart perspective. Those of you who maybe have longer term time frames, you probably should be looking at weekly charts. Maybe a daily chart for an entry or an exit, but really the guiding principle of your trade should probably be that long-term weekly chart. Went through a bunch of examples. You're certainly free to take a look at this recording later. Go back through those. You want to make sure you can identify those false breakouts. I think from a short-term trading perspective, they're incredibly important to take your profits. Otherwise, you risk just watching the profit on the trade erode. And that's the worst thing as a trader, is having a nice profit, not taking it, and watching it turn into a loss. The elevator analogy, I think in an uptrending chart, I think you can probably, probably can, understand that. Or maybe stair stepping might be another way. Maybe if you look at an escalator, the way the stair steps go up, that's generally how you normally see these uptrends begin, with a move to the upside, pull back to a higher low, break out, pull back to a higher low, break out, kind of like stair stepping to the upside. And then finally, while price support and resistance and volume are all great, it really helps when you combine it with other technical indications. Could be moving averages, could be trend lines, could be the candlesticks. There's just a lot of different things that you combine with it, but can really help to improve your trading. And so with that, Aaron, I think we are just about up to the 10 in 10. So I think I'm just going to go ahead and keep the screen.
Yes.
Pull up the 10 in 10, and let's do this.
All righty. Well, we told everybody we'd start with Costco. I know you kind of covered that off early in the show, but I think annotations would be welcome.
All right, let's take a look at Costco. A couple of areas. And now you probably can understand why my favorite indicator, my favorite annotation tool is auto support and resistance. I use this all the time. I think here you can see that was a prior high. We broke out above it. Notice the next day after we made this breakout, look at where the tail came down to, right to that prior high. And then we turned back up again. So there are a couple areas here. I think this is a really nice flag that just broke out, had a nice uptrend here, flagpole, sideways, little flag action, and then a breakout. But as I mentioned earlier, I'm a little concerned about the shape of the candlestick right now. I'd like to see strength into the close and finish on or near the high if you want to see this go up higher in the near term. Other than that, I mean, I think if we finish with this or if we start to pull back and maybe have a shooting star candle, then I would expect maybe a little bit of a pullback to test the rising 20-day. I mean, maybe price support at 190, but I wouldn't be shocked to see a rising 20-day test. And right now that's down closer to 183.
All right. Number 2, Starbucks.
Oh, my 2 favorite stocks back to back.
I know, right?
Wow. Okay, Starbucks. Yeah, I mean, I think that this one is really starting to behave a lot better. This to me looks a lot like that FFIV chart I just showed, and I'll show you why. All right, first of all, we got some support down there. You can see we got some resistance. We gap down. Now in this case, we didn't have a hollow candle, but we gap down, big volume, sideways consolidation. Notice the volume pick up on this break to the upside, and that's very similar to a 3 white soldier pattern. Notice, where did we pull back to? We lost the 20-day moving average, so you might throw your hands up and say, oh, wow, this thing's doomed. But price support held. So while I like the 20-day moving average, price support is my biggest technical indicator that I use. And this thing came right down to price support and then right back up, and the volume picked up again on this push to the upside. Now, I do like price support, which I'm going to say comes in right at about 57.80, and that rising 20-day moving average, which is at 58.21. That is the support zone that I would be watching on Starbucks.
Okay. Number 3, CV as in Victor X.
All right, CVX. All right, this is not one of my favorite stocks. I don't spend much time in CVX.
No.
Or, Chevron. Every time I go there, I got to pay. So I'm not. Of course, I do pay at Costco and Starbucks, so maybe that's not a good thing to say.
Yeah, don't talk to me about gas prices.
Yeah, I'm sure mine are a lot cheaper than yours, but we can save that for a different segment another day.
Yes.
Let's see here. Here was the prior high. So here was the move up. Here's your pullback. So that has now clearly established resistance. We come up, look at the volume, break through that prior resistance, and so far, notice where we are holding to the downside. So I think, again, the combination of price support at 119 and this rising 20-day moving average, which is currently at 118.63, that's your support zone on CVX. What I'd like to see is a breakout above 121 with increasing volume. So I think we're in a real narrow range. This is a nice flagpole with a flag afterwards. I think a breakout above 21 with increasing volume would be bullish here.
All right. Let's see. And the next one we have is Suncor Energy, SU.
Okay, SU. Now, this one has actually gone back down below price support. So that's interesting, or at least one level of price support. So if I was trading it, one of the things I would have been looking for, and actually, we did come down and go below it intraday, hold it, go to a new high the next day, and kind of held it for maybe a week or so before finally breaking back down. You can see a shooting star candle right here, first day of December, testing the short-term price resistance before we came back down. That is actually a piercing candle, which is a reversing candle off of the downtrend and back up again. So I think right now, Suncor is just looking for support. There are a couple of levels maybe to watch. You can see the prior high here when we broke out. We came back down just below the 50-day, but we held price support and then made another run to the upside. Now we've pulled back. The biggest level on this chart, as far as I'm concerned, is this price support level down here, 32.50. But I really, from a trading perspective, now that we've gotten this reversing candle, I'd like to see 34, maybe just below 34, hold as support on SU. And I'd actually be looking for a return back up to about 36.10, 36.15 to test the price high in November.
Okay, let's see. The next one is COHR.
Yeah, I was looking at this one earlier. I think it's on my strong earnings watch list. But let's take a look. COHR. Yeah, this one I think is pretty interesting. Notice this tail. I mean, I don't make this stuff up, but when it tries to get through the prior resistance level, right here. Tried to make that breakout, comes all the way back down. That's a shooting star candle off an uptrend, and then we go back down. When you see those types of candles, you want to be careful. Now, we've got a couple of different areas. Here is your price support, and then this is your gap support. Notice the big volume on the gap up. This is the bottom of your trading or your gap support. You got the 50-day coming up in between, and the stock broke down below price support temporarily, but held the 50 and held gap support. So I think this is the biggest area on the chart. I think you probably could also draw a trend line. Like I said, you can also use other technical signs, which I think are really important. And you can see that from a trend line perspective, right about 280 holds. So if you go back down and you lose 267, you lose trend line support, you lose the 50-day moving average, you will have lost the 20-day moving average, price support. I mean, the list goes on. And it probably at that point, you're going to see the MACD turning negative as well. So I think this is a really solid entry for, or entry zone from a reward to risk standpoint, looking for a move back up to 320.
Okay. Number 6 will be DB.
All right, Deutsche Bank. First of all, it's a great area of the market, banks. But this one has not performed as well as many of the other banks, which keep setting new highs. And I think if you look across here, you're going to see right at about 1950 or so is where we have been struggling. We get up 19 and a quarter. I'm going to put that in there. This high over here, 19 and a quarter. Here was 19 and a quarter. This was 1950. This was between that. I think this is what you would consider maybe a gap resistant zone. And that is where we are struggling here. Now, we are a little bit above it today, but I would like to see a lot of volume coming in to support this. So if I was going to trade a breakout, I need volume to support it. Otherwise, maybe gap support in that rising 20-day. This is one bullish development. I do like the fact that it came down after this increase on heavy volume. It held the rising 20-day and broke to new highs. I find that to be very bullish, but I'd like to see some more volume coming in.
All right. Let's see. The next one we have is FL.
Okay, FL. Footlocker.
Yes.
Well, first of all, footwear has been on fire, mostly because of Nike. But I think part of that, I think that helps Footlocker. But just the fact that the retail in general has gotten so strong, that's probably the bigger news here. So I think what we had is really a breakaway gap. So here was your downtrend, which was clearly in play. To me, what a breakaway gap represents is a breakaway from the prior trend. So your prior trend is lower. I think this breakaway gap on massive volume is starting an uptrend. I think these recent highs are kind of proving that out. So I like the stock. Now, as far as price support, I think the reaction low here after the gap up, I think is pretty important. And then the recent breakout. So I'm going to say the best support on this stock is down maybe 39 to 42, and we're up at 46. So I don't like the reward to risk trade, but I do like this stock, and it would be on my list to watch for a pullback.
Okay. Let's see. We're almost there. You're doing really good today. Let's see. Microsoft.
Let's see.
MSFT?
Mr. Softy.
Yes.
Love the break. Look at the volume coming in. Now, this is what I'm talking about on a breakout. This is what you want to see. Now, part of the problem with Microsoft for a while, and that's why I follow these candlesticks, after this uptrend, great earnings, but look at that candlestick. The high that day was the high for 2 months or close to 2 months. It's just been sideways. It's been very frustrating since then, but there's nothing wrong with this stock technically. In fact, this was a pretty big scare right here. And when you look at these gaps, the price or the support is your move to the upside top of gap, and here's the bottom of gap. So unless Microsoft was to drop back down below 78 or 79, I wouldn't have been that concerned about it. Many stocks will go back and fill their gap after earnings, but this one did in the middle find its support and then took back off. And like I said, volume today is very strong on this breakout. So I would be looking right at about there. You can see the top from this candle and then the recent closes. If we confirm this breakout, I would expect going forward, 86 should provide us some pretty good price support in the days ahead.
All right. Number 9 is EA.
That's Electronic Arts.
Yes.
And let me just do a little housekeeping here. All right, EA. There's so many good stocks out there, and this was not a bad stock. It just went up so much, got so overbought, and now this is going to be kind of a wide range, but there was the top of your gap. Here was the bottom. I mean, it could be that it's finding its home here to the downside in this range, but look at all this volume on these moves to the downside. Gap down, we come back up, essentially, well, even a little bit above gap resistance, but then we come right back down. We had a support area, I'm going to say right about in here, and we did another gap. So here's your first gap on heavy volume, came back up, second gap on heavy volume, and then you can see some other big volume days just going through these support levels. And now we're turning back to the upside. I think that 50-day moving average and that prior support, which now becomes resistance, maybe around 111, is an area this stock needs to get through before I would consider it. So longer term, and this is probably one of those, I'm going to go ahead and just save this annotation, but I do want to pull up the weekly chart because this could be one of those situations where the daily chart looks really bad, but the weekly chart could be testing maybe a rising 20-week moving average or something along those lines. So let's just take a quick gander at the weekly chart. Actually, we had a negative divergence, higher prices, lower MACD, and we're getting a center line reset with the 50-week test. So I look at this chart and I'm much more bullish than I look when I look at the daily chart. So I would say based on this, going back to that daily chart, yeah, I mean, current price is maybe a little bit of a stretch, but if we were to pull back anywhere near the recent lows, I think based on what we're seeing on that weekly chart, that would seem to me to be a good buy with the high around 122 as your target.
Okay, last one is for our Canadian friends, and that would be GIB/A.TO.
All right, GIB/A.TO. Well, volume is picking up, and check out the potential breakout here. I like this stock. Now, I want to get the breakout, of course. I don't want a false breakout after everything I just talked about. Here we can see we tried to break out above this high. We failed. Look what happened. Here we came up. We tried to get above this prior high. Look what happened. So right now, we got up to 70 earlier, but now we're back at 69.31. If we leave that long tail back above, I would be really careful this could be a possible short-term top. With this kind of volume, if we strengthen, this will confirm the breakout today. So I think today it's just going to all be about the close. Can we get that close? I mean, if we close where we are right now, it is a breakout, but that I'd feel much better if it closed at 70. Make it a clear-cut breakout with heavy volume. I would suspect that they would be the start of a pretty good move to the upside. And to the downside, I could then establish a key price support at 69.10 or whatever that number is, and then also the rising 20-day moving average. Those would be the two areas I'd watch from below.
All right. And that does conclude the 10 and 10. We went over 10 symbols today. We made it all the way through, and I have listed them here. You'll find them in the Market Watchers recap, and especially we do upload the Market Watchers to the Market Watchers live chart list, which you'll find at the top of our blog. All of those symbols are in that Market Watchers live chart list. And with that, let's go ahead and get to a market update. All right. All right, I'm just going to start us from the home page here and go down to our candle glance. Always want to make sure everybody knows how to get there because this is a great page to have bookmarked or on one of your tabs. And as we can see, the markets have been moving higher today. We've been setting some new all-time highs. Intraday, we'll have to see if we can close on those new all-time highs. Look at the NASDAQ. The NASDAQ is just having a beautiful day. It is moving straight up with very, very little hesitation. Finally getting to see the tech space starting to improve. You can see Russell 2000. The small caps are also having a really good day. And I happen to know, having looked at the indicators and such, this is a really important point of support right now at about 27.5. So to see that bounce off of that is very encouraging and should hopefully change some of my negative indicator charts for those small caps right now. Treasury yields are higher, reading at 23.67. The dollar has now pushed up into a new intraday high, and we can see UUP reading at 24.42. Commodities are mostly unchanged right now. USO up slightly at 11.47, and gold had a beautiful morning. A nice gap up. It has been pulling back ever since, but it's still on the positive side at 119.04. And the VIX is starting to rise again, but we're still looking at readings below 10, currently reading at 9.55. Advances leading declines. Let's go ahead and look at our big scooter movers for the day. And so you can come over here to your technical rankings, or you can change it to top 10, whatever you want it to be. And I'm going to look at scooters for the large caps. These are currently the top 10 that are in the list. And you can see that obviously it shouldn't be a surprise to see some of these names, as we have been seeing some great moves. Look at that Michael Kors chart, straight up move off of that gap. Very pretty chart. But let's go look at some of the top up. Who are making the big moves currently today as far as scooters? And we could see that Crary is doing, it's moved its scooter up, but I'm not seeing a really great chart here, chart pattern. Vertex, let's see, this was the one I think I was looking at earlier. And you can see right now, earlier it bounced off of that gap support there, and now it does seem to be heading higher. 5-day EMA is about to cross over that 20-day EMA. That would give us a short-term trend model buy signal. We can also see a PMO buy signal in the works. And of course, there's that scooter and the reason why it's on that list, as it is moving higher currently. The next area of overhead resistance, I would probably annotate a declining tops trend line. So I think we're sitting on it. What you really want to see here is that move above that 50-day EMA, and especially a 50-day EMA positive crossover, which we haven't got. But support has held up on the 200-day EMA as well as off that gap support. And with that, that is the end of the market update. And I guess I will go ahead and did you have any comments on the market update first, Tom, or I'll just get into sentiment?
No, just a bullish day on the NASDAQ for sure. I mean, the 69.12 is the high close all time. And so we were around 69.30. So it's potentially a really big day for the NASDAQ. And of course, the Russell 2000. And I had written about, once you get past the middle of the month, the Russell 2000 tends to do extremely well. And today, it's already seems to be starting. It's up really nicely. And it would be the highest close in about the last 8 or 9 trading days if we finish where we are right now. So starting to see that small cap strength, maybe starting a little bit early this month.
Yeah, of course, like I said, it's because I just, published a Chart Watchers article that showed all these bearish indicators. So I did mention you in that blog article as telling everybody that the last half of December seasonally is generally very good for the small cap. So I did give you a shout out there. And because my indicators are looking pretty negative right now for I follow IJR and IWM.
Yeah, and all I was doing really with the Russell was just pointing out historical facts. I mean, it really was an opinion on what I was, thinking about the market last half of December. It's pretty interesting when you look at December because it is by far the best month of the year for small caps for the Russell 2000. And if you look at the first half of the month, over the last 30 years, the first half of the month has an annualized return of like minus 3.5%. The second half of the month has an annualized return of 74%. So, I mean, I'm not making this stuff up. It's just the way the market has worked.
Exactly.
And I think folks just get into a festive mood. I think some of it's psychological as you head into the holidays. And, knowing that the market is as strong as it is right now, I suspect that folks are just going to continue to bid prices higher into year end.
Yeah, absolutely. So this was the chart I was showing of the small caps, the Russell 2000. And, when I wrote this article yesterday, things are looking pretty negative. I did mention, though, that we are sitting on a pretty important area of support. And let's see, I'm going to pull up IWM. Did I annotate that one? Oh, No, this is what I did. If you download the Decision Point chart pack straight shots, there's what it is. You will get all of these indexes, and you can get all of those indicator charts that I show for the S&P. We also have them for all of these the other indexes. So this is where I went. I went to go see what my indicators were telling us. And I didn't publish this one on the short term, but I mean, it was still very negative. You're seeing that top below zero on the Swindlin trading oscillator there. And then I think I showed, the 20, 50, 200, 20. And you can see all of these are still falling. You've got a third of the S&P 600 sitting on only 66%. So a third of them are below their 200-day EMA. That's a pretty bad situation. And we're not really seeing oversold readings here. So, and they're continuing down. So my indicators are still saying it might be a little bit longer before we get that big rally, but they are starting to get in that oversold area. So while we may not see Santa Claus right away, we should see him maybe in the new year for sure, is what I would be looking for based on these indicator charts. But wow, you can't argue with a big bounce like this. So we'll have to see whether that support area holds and whether we can start challenging new all-time highs for the S&P 600. So just a little bonus there for everybody. But let's go ahead and get into the sentiment. Okay. All righty. I'll get to my sentiment indicators. There we go. All right, so I'm going to start, as I usually do, with the 10-day moving average of the put-call ratios. And what I've highlighted here, so this is the S&P 100, which is what I compare it to. We can compare what's going on with the CBOE put-call ratio and the equity put-call ratio. And these, of course, are 10-day moving averages of such, and the OAX. So what we look for, of course, are bottoms and tops. And typically, when you come out of a bottom, this means that you've got, your number's getting lower and lower. So what does that mean? The put-call ratio, the calls on the bottom are larger. So you're getting smaller and smaller numbers. So that means people are bullish. And so when you get these lows like this, you should expect coming out of those to get some sort of a decline. But we can see, since, back here in mid 2016, that didn't necessarily come to fruition. So we got really nice oversold, bottoms, in my opinion, the bottom of this range, and we're coming off of it. So I would be expecting at least a pause or, some sort of decline. But, again, with bull market rules that are applying, and wow, in a big bull market like we're seeing, the expectation shouldn't necessarily be so bearish. So what I would be looking for, and I still am looking for, is a bit of a pause here before we get in closer to the holidays and after. So kind of a surprise to me that we're still seeing prices move up and setting new all-time highs, especially when I look at some of this sentiment. So at this point, I would rule it neutral. We are starting to rise, but we're sort of midway in this range. I don't think we are seeing much right now, because we do want to look for those climactic, tops and bottoms. That's where that's where the information is. All right. So this is the AAII Investor Sentiment Poll, American Association of Individual Investors. So these are, regular traders, you and me. We go in, take the poll, and say, okay, I am bullish or I am bearish. And so it's kind of a cats and dogs poll, because you do get a lot of different opinions, obviously. But what really struck me was that currently now we're seeing a bull-bear ratio that's starting to rise quite a bit. And that would mean that we have an excessive amount of bulls if your ratio is rising. So for example, what we really look for is when we get, at least twice as many bulls as bears. So, a 2-to-1 ratio. So that's what we look for as extremes. And we're not quite there. We're really, really close. And typically off of these very bullish extremes in terms of everybody feeling very bullish, that's bearish for the market. If everybody is super, super bullish, then you should expect the market to start turning down because everybody got in and now the smart people are getting out. But what we're seeing a lot of right now is, of course, everybody staying in, just rotating the money into different sectors. And so it's, we're not seeing kind of the same action that we would normally expect off of these sentiment numbers. But the important thing and what I've marked here, again, are those climactic readings, those readings above 2. We're not above 2 yet, but we're making our move very close to it. And we already did back here. And again, typically what you're going to see after a really bullish, bull bear ratio, when people are very bullish, you're typically going to see that decline. And, looking at prior bull bear ratios, this is why I say, basically after the election, the rules changed. We don't have corrections. We have little pullbacks or consolidation. And so I think this kind of speaks to that because we had an excessive amount of bulls, but we were coming out of this decline and, people were starting to feel more bullish about what's going on with, the election, et cetera, et cetera. And so even though we got these very climactic high moves as far as people feeling bullish, it didn't really end up into much except for a little bit of a consolidation here. So, and here we can see a decline. This is a short decline and then consolidation, decline. Difference right here, you got a little bit of a rise. But typically when you get these very bullish ratios, you should expect a decline coming off of them. And you could, mark all of these others and see a similar situation. Again, you look back here in early 2012 and you had this excessive ratio, but we didn't get any kind of a pullback. And I suspect if we went back in time here, and I think this is a good thing for you all to see how to do anyway, because I've seen some questions on this. So when you select the start end, not only can you just, slide your slider back because we want to see what was going on back then. There we go. So the one I marked, right, we still ended up with this move higher. Wait. No, we want to go back further. Yes, there. Yeah, so we got a dip, but when we ended up right back up. So we didn't get what we would expect off of these types of readings. So let me take us back. Actually, I'm going to show you one other really cool feature of this since I have just a little bit more time. We're almost done. And I'm going to switch this back to my 5 years and give us an update. All right, so a lot of people have difficulty. This would probably be easier to show on just any chart here. That you can't tell necessarily when these crossovers occur. You want to see what's actually happening day to day. So go down here, get your custom, and you can move it back a day or two if you'd like, or you can leave it there and just click these arrows and watch what happens to the PMO. We can actually see it moving slowly. So I like to do this sometimes because it's not always clear when a crossover occurred, etc. So right here, that would have been considered a whipsaw. It looks like we probably stayed. See, I'm looking at it right now. It doesn't look like we got the crossover. So that's just a nifty trick that you can do that I absolutely love because I'm always looking for when those crossovers occur. So anyway, that's just a bonus for you. All right, so next I showed you AAII. Now we're going to look at the National Association of Active Investment Managers. And this is the big money makers we're always talking about. These are the big portfolio managers. And wow, I was shocked when I pulled this chart up. This is the highest reading that we have seen in how many years? 6 years and 9 months. This is the highest exposure rate we have seen from these guys. That to me would be worrisome because, again, this is excessive. This is excessive bullishness. And look what typically comes off of these large moves. Like I said, we probably will get lucky this time with some consolidation just because those bull market wins are so high. But typically, you get these very high readings and you get a decline off of them. And you could see right back here in the middle of 2016, that was a pretty, not a deep correction, but it was certainly somewhat painful on that decline. And it came off of high exposure by these active money managers. So this is something to consider. If they're getting very bullish, that'll mean everybody else is going to be getting very bullish. And then what do you expect? Everybody's hops on that bullish wagon and the wheels fall off. So let's go to the Ridex analysis. This is not a poll. This is money where your mouth is. We look at a pool of Ridex funds. They're under Guggenheim's name now, but they have a collection of them, and they tell us every night how many assets are in each of those funds. And so we tally up the amount of assets in the bear funds, in the money market funds, and in the bull and sector funds. And we watch where the assets are going. Where is the actual money? Not what they feel, but what are they actually doing? And so I think this was a really interesting chart as well. So recall, we have high exposure right now in name, and we have high bullish numbers in the AAII. Those are lagging somewhat because those are the numbers as of a week ago. And what's starting to happen right now? Interestingly, we're seeing money moving out of bear funds, moving out of bull funds, and starting to increase a bit here in the money market funds. So I would suspect that this could be the assets moving. It could be a matter of, holidays kind of coming up. People don't want to be holding into a time when they can't be watching what's going on. And that's why we're seeing that decrease in both. We're not getting this huge increase in the money market funds. So, it seems to me there might be some cashing out going on here. But because this is right up to the date, I think the fact that you're starting to see this money coming out after we're seeing those excessive bullish readings is very interesting. So that pretty much concludes my section on, let's see here, on the sentiment. And so I just wanted to put up a summary for you all. I'll have this in the Market Watchers recap, but basically the put call ratio not telling us that much. AAII is very bullish. It hasn't gotten to extremes. We're seeing bullish extremes. Like I said, a reading higher than we have seen in almost 7 years on name. That's excessive bullishness. And so seeing that, not very good. Remember, we've got the money is moving out of the market and money market assets are beginning to rise. So that's telling us that what this is saying is we're looking bearish. And this is telling me that after this lag here, what's actually happening now is a result of that. We're getting some bearish activity going on in the Ridex ratio. And to conclude, if I can get back to it. So the polls are really bearish. And Ridex, which is more timely, as I was saying, is leaving funds. And that could be really read as a follow through on those sentiment polls that we just looked at. So with that, I'm going to turn it back to you, Tom. And I don't know if you saw any questions in the question box you wanted to answer. I do know, just real quick, that there's been a question that's followed a day or two, and I apologize for not asking Tom this question, but they wanted to know if you use 30-minute and 60-minute charts when you're evaluating a position you're getting ready to jump into.
If a chart is downtrending on the daily chart, getting close to support, occasionally I'll pull up a 60-minute chart just to see if I have a positive divergence there on the move to the downside. That gives me a little bit more confidence in the trade. But very rarely would I look at a 30-minute or a 10-minute anything like 15-minute. I mean, occasionally I will go to the hourly chart when I'm ready to pull the trigger. And it doesn't always matter whether I see that positive divergence or not. But if I do see it, it just gives me a little bit better feeling about the trade. So I will use it. I went into the chat box and I was actually trying to look at the questions and was answering some questions, but I know some of you probably don't look at the chat box. So I'll go through and just some of the questions that were asked, repeat them real quick. One question came in was why I don't use the 17 and 43 week moving averages. I just don't. That's not my strategy.
Yeah, they asked that because I use those on my weekly charts, I think. 17 and 43 week EMAs.
Yeah, anytime I pull up anything on my charts, I try to predict. I mean, I try to use the default settings because that's what most traders will use. And if I'm trying to predict what others are going to do, then for me anyway, what works for me is I need to see what they're seeing. So for the MACD, I like to use the 12 and 26 period EMAs. For the RSI, it's the 14.3, stochastic 14.33. There was a question about stochastics because it's on my chart. Why, what do I use it for? Well, if you've been watching the show for a while, you probably know I don't use it for much. Maybe just a little decoration at the bottom of my chart. I mean, I will use it. Like if the RSI gets down to 40 during an uptrend, a lot of times stochastic will be down around 10 or 20. So I use it maybe as a little bit of confirmation on the RSI. But of the two, I prefer the RSI, and that's why I have it on top and the stochastic on the bottom. Let's see, there were some other questions here. Someone had asked about pivot points. Is that the same thing as price support and resistance? I've heard pivot points. I hear inflection points, price support, price resistance. I mean, I think all of those are very similar descriptions of the same type of thing where we're seeing reversals in the market.
I think they talk a lot about, excuse me, pivots when you're looking at point and figure as well.
Mm-hmm. Let's see. Another question came in. Do I look at the weekly, daily, hourly charts and so forth? I just talked about that a little bit. I look at all three. I do like to look at the weekly charts, even though I'm a short-term trader, because I do think sometimes that helps. If I see a daily chart breaking down and I think, well, that's kind of strange. Why isn't support holding? And then I look on the weekly chart, I see that I'm getting very close to a 20-week moving average test. So sometimes I can overlook that daily breakdown if I see that the weekly chart's still holding up. So that's kind of how I use that. Question, do I ever short? During a bear market, I will. But I don't short during a bull market. I'm not going to waste my time trying to find stocks going down when 70% of them are going up.
Yeah, amen.
And then there was a question, I think, on that chart that I had on BUFF, where I had shown that false breakout. I think shortly thereafter, when it came down, there was a reversing candle, or what might have been a reversing candle. I didn't go back and look at it, but I think there was a candle that looked similar to a piercing candle. I don't know whether it actually was, because technical definition is for a piercing reversing candle. It's kind of like a bullish engulfing candle, except it's just not quite grown up yet. So it gets up to about halfway or a little bit above halfway of the prior day's candle. So it just doesn't, it's kind of like a junior version of the bullish engulfing candle, but I don't recall if it actually got up halfway. But either way, I think that candle, from what I recall, had a really long tail to the downside, and there was a big reversal, and that typically is a good sign for a stock. And I think that was it. There may have been some other questions. I was trying to get back to them, but I know we're getting short on time. So anyway, just to wrap up, anything as we end this week?
Well, guess what? We have to tell everybody what we think is going to happen next week.
You got 10 seconds.
I'm going to actually go bearish this coming week, which I think, well, let me take it back. I'm going to go neutral because it is a seasonally, it is a pretty good time of the year right before Christmas. So, but there's still some weakness in my indicators right now. So I have to go neutral.
All right. I'm going to go bullish. I'm not going to fight the Santa Claus rally. I think the market's going to go higher. So I'm going to go bullish. And I think you won last week because you were bullish last week and I was neutral. And it looks like the market's having a really good day today. So we'll see how next week pans out. Of course, we can get everybody's response. Maybe we can talk about that a little bit on Monday. But let's go ahead and wrap up. Again, want to thank everybody for stopping by. We do have a Chart Watchers newsletter out this weekend, so be looking for that. And Greg Schnell will join Market Watchers Live again next Wednesday, December 20th. We always love to see Greg on here, so that should be a very good show as well. Again, thanks to everybody for stopping by. Please remember to complete the survey as you exit. We'd love to get your feedback, hear what you think of Market Watchers Live. Market Watchers Live now airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. See you back here on Monday. Happy trading.